Let's bring in Macro Risk Advisors, Chief Technical Market Strategist, John Kolovos, right here at Post 9. Good to see you, John.
Good to see you, Mike.
So you're deferring to the trend. You're saying there's really nothing that the S&P is doing wrong right here, but fill in the story a little bit.
All right, so there's nothing really wrong with it. A good solid uptrend, higher highs, higher lows, above moving averages, no discernible top patterns, all that. My job was just to call the S&P. Easy peasy. Still think 6,000 before the end of the year. When I look into next year, perhaps at first quarter, 6,300, maybe even a 66 handle at some point next year. We keep grinding higher in this uptrend. Support at 65.50 until we break underneath that. I think we can continue.
56.50.
I'm sorry. Yes.
Yeah, the numbers get confusing.
Yeah.
Okay, so what else, though, is there to actually keep an eye on if that's the case?
Yeah.
I mean, what's happening under the surface or across markets?
So there's a couple things going on here. One, when it comes to volatility, I think there is a potential for a liquidity vacuum the more that we push up higher. So I do think we will get that election sort of shakeout, but I think it'll be at a higher perch, so maybe closer to 59 or 6,000. Then we'll get the pullback, but that pullback should be embraced and pushed up to the upside. You know, you keep buying cyclicals. I really like the cyclical areas of the market, emerging markets, and et cetera, et cetera. So there's a lot to go on underneath the surface, a lot of rotation. But yeah, the trend for the equity markets is still on track.
Yeah, I was going to say, I mean, 6,000 is like less than 3% from here, right? So we continue to kind of run ahead of our mental model for kind of where we should be. But so that's how bull markets go. On the bond market side, yields definitely have gotten more than perky. In fact, if anything, they look a little stretched in the short term. But how do you see that going, and how should we be thinking about that path?
Yeah, you're totally right. And I think we have to pay very, very close attention to what's going on here with interest rates. If you take a step back, interest rates are in a secular uptrend. They put the low in around COVID. They're going to be going up for my lifetime.
We're talking about
lifetime.
Yields, market yields.
Yields, right? 10-year yield going up over time. So going into this year, I felt as though they were going to consolidate. Low end was going to be at 325, but I was really looking at that 360 level. When the Fed cut 50, where was the 10-year? 360, and then it ripped higher. When that happens, as a chartist, you've got to pay very, very close attention to that. So now the question is that consolidation phase over or not? And I'm leaning towards the case that you're pretty darn close to the end of that consolidation phase. You're right, extended in the near term, maybe 420, it acts as a bit of a resistance level. But as long as 385 holds, you're kind of backing and filling. I think the consolidation phase is pretty much close to being over when it comes to interest rates.
So therefore, we should be prepared for yet higher yields from here.
Correct, yeah.
And what's your take on the interplay between that and stocks and the kinds of stocks in the economy? In other words, is it going to be okay if it's happening for the right reasons?
Yes, correct. And currently, it is still okay for the right reasons. Cyclical stocks are acting very, very well. I've shown a chart in the past that would show the inverse relationship between interest rates and breadth. So if interest rates were to go up, breadth will go down, right? Interest rates are going up, and guess what's going on with breadth? It's actually gotten better. So the market's shaking that off. So long as it's not a huge spike up, maybe it's the fiscal grenade that may go off, it's going to freak people out. That doesn't seem to be the case. The way I approached it was, macro sentiment was so bearish going into the Fed that this is part of the resetting. I didn't see this as being a hard landing. I thought this was going to be a soft or no landing. And the interest rates have been showing us that. It's been an orderly pullback to a certain extent, and now we're resolving higher. So the way I would play it would be to look more towards cyclicals.